Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management Practical Question 17. Mr. Abhishek is interested in investing 2 lakh for which he is considering 3 alternatives. Invest 2 lakhs in mutual fund X, MFX, invest 2 lakhs in mutual fund Y, MFY, invest 1 lakh 20,000 in MFX and 80,000 in Y. Now average annual return of the MFX and MFY is given 15 and 14, and risk-free return is 10% and market return is 12%. So the risk premium will be 12 minus 10% 2% multiplied by the beta. Now the covariance of returns of MFX, MFY and market portfolio, which is market return mix, named as mix, are as follows. They've given a table, covariance table. Now we are required to calculate variance of return from MFX, MFY and market return, then portfolio return, beta, portfolio variance, portfolio standard deviation, expected return, systematic risk, unsystematic risk, Sharpe ratio, Trainer's ratio, alpha, alpha of MFX, MFY and portfolio mix. I would consider this as an LDR question, last derivation, because it has everything whatever we discussed till now as a full-fledged question. Now going to the solution, first they are asking the variance of return from MFX, MFY and market return. They have already given the covariance table, so we can directly pick the values from here. As we have seen in our previous questions and discussions, covariance of a security itself will be the variance. So even in the table, the diagonal values will give us the variance. So covariance of MFX with MFX is 4.8, which is nothing but the variance. Same way MFY with MFY 4.250 will be variance of MFY, and market return variance is mix with mix 3.1. So taking those values, they have also given the same thing. Now the second requirement is portfolio return, beta, portfolio variance and portfolio standard deviation. Here ICAI has considered only the third alternative as portfolio, which is this 1,20,000 in X and 80,000 in Y, but I would suggest writing all this for in the exams, as even the alternative one will be considered as a portfolio. Portfolio is nothing but whatever investments we have, right? So I can just invest in only one stock, even then my portfolio will have only one that return. So the three alternatives also has to be considered when they are asking this general requirements, because they have not mentioned specifically the third alternative or in what portfolio X and Y has. Now considering this, first they are asking portfolio return, and if we are investing only in mutual fund X, then the portfolio return will be 15, and if we are investing only in Y as the second requirement, so the second portfolio will be investment in 2 lakhs in mutual fund Y, so which will give us the return of 14%. So portfolio return also will be 14% in the second alternative. And in case of third alternative, we have to calculate the portfolio return, which will be weighted average. So 1,20,000 divided by 2 lakh, 60% is the weight and 40% in case of the MFY, mutual fund Y. Now multiplying with the returns, annual returns will give us the portfolio return for third one. Now the second one, in the second requirement, the second portion is beta. So the beta of Mutual fund X they've calculated here, which is nothing but the covariance divided by the variance, market variance. And as we already know, they've given the covariance here, and the covariance, the beta will be covariance of the security with the market. So using this table we can find the covariance of MFX with the market, which is nothing but this MFX with mix, which is 3.370. Same case, MFY with the market is this one 2.8. So this will be the beta, sorry, this will be the covariance. This divided by the market variance, which is 3.10, will give us the beta. So 1.087 in case of X, and 0.93 in case of Y, which is the second alternative. And third one, a simple weighted average will give us the beta for portfolio, which is 1.013. Now the third one is portfolio standard deviation. Again here, in case of the first alternative, whatever portfolio the third one is portfolio variance. So whatever the variance for MFX and MFY will be the variance for first and second. In case of third alternative, we have to find out. So which is nothing but which we solve in our previous formulas, a plus b the whole square approach. So just nothing but a square plus b square plus 2ab with the correlation of a and b. Now a square signifies the weight of a multiplied by standard deviation of a the whole square, and b is nothing but weight of b multiplied by standard deviation of b the whole square. Same thing they have did here. So this is what is a square in our case, this is what is b square, and here as we have previously seen also, the weight of a with standard deviation of a, and then weight of b standard deviation of b multiplied by the correlation of a and b. We don't have correlation of any security specifically here, a and b. So the standard deviation of a, standard deviation of b multiplied by the correlation of a and b will be the covariance of a and b. Now covariance of a and b multiplied by weight of a, weight of b into 2 is what they have given here. So substituting the values, we will get the portfolio variances 4.472, and root of 4.472 will give us the standard deviation of portfolio, and rooting the variance of X will give us the standard deviation in case of first alternative, then second, and then the third. Now the third requirement, expected return, systematic risk and unsystematic risk. The total variance will be the total risk of the portfolio, and if we find out systematic risk, then unsystematic risk will be nothing but the total risk minus the systematic risk. And for expected return, we can use CAPM approach, as they have given risk-free rate and market return, risk-free rate of return and market return. Now substituting this in this formula, RF plus beta into RM minus RF, wherein the risk-free rate is RF, and then this is nothing but the risk premium. Calculating that using the betas we found out, and the rates which are given 12 minus 10, we are getting portfolio expected return as 12.3 in case of the portfolio return, and MFX is 12.7, which is the first alternative, and the second alternative is 11.81. Now systematic risk is nothing but beta square multiplied by market variance. So we know the market variance as 3.1 multiplied by the beta square of respective portfolios. So MFX, the first alternative portfolio, 1.087 the whole square multiplied by 3.1, 3.663, and in case of the second one, the second alternative mutual fund by 2 lakh investment, so where there the risk is 0.903, sorry, the beta is 0.903 the whole square multiplied by the total variance, 2.528 will be the systematic risk, and in case of portfolio 3.181. Now reducing it from the total variance which we have previously calculated will give us the unsystematic risk. Then going to the fourth requirement, Sharpe ratio, trainer ratio and alpha. Sharpe ratio is nothing but the excess return per unit of total risk. So Sharpe ratio is a measure which gives us how much excess return we got for the corresponding total risk of the share. So the formula for that is nothing, the formula for that will be return of the portfolio minus the risk free return, which will give us how much excess we earned for every rupee of risk of the portfolio. So in the first case, let's say for MFX, the standard deviation is the risk. So variance is 4.8. The root will give us the standard deviation, which is nothing but 2.19 in our case. So 2.19 is the overall risk. So for 15% is the portfolio return minus 10% is the risk-free return. So 5% is the excess return we earned. So that is for 2.19. For 1 rupee or 1 unit of risk, how much is the excess return earned? So it is 2.282 in case of MFX1. So for every 1 unit of risk, we are earning excess 2.28% of return in case of MFX1 in the first alternative. In the second one, same case, 14% is the portfolio return minus, so here portfolio I am signifying it is only of MFX. So portfolio return or the stocks return minus the risk-free return divided by the risk of MFY, here nothing but variance square, sorry, root of variance, standard deviation is the risk. So MFY is earning 1.94% extra for every 1 unit of risk. Now portfolio return also same thing, we'll divide it by the portfolio risk, and then excess we are earning is 4.6 divided by 2.15 will give us 2.175. Now trainer's ratio measures the excess return per unit of systematic risk. In case of Sharpe ratio, it is the total risk. In case of trainers, it is the systematic risk, which is nothing but beta. So as we have seen in our previous discussions, beta is the sensitivity of the stock towards the market return, and that clearly explains us the systematic risk of the stock. So the excess return which we earned for the systematic risk that the security is having. So in case of MFX, 15 minus 10 will give us the excess return 5% for 1.087 of systematic risk. So 4.6% is what is the extra return for the systematic risk. And in case of MFI it is 4.43. In case of portfolio return it is 4.54. Now alpha here signifies the Jensen alpha, which is nothing but how much excess return earned by a portfolio compared to what CAPM predicts. So it is nothing but the alpha is equal to actual return minus CAPM expected return. So how much extra we are earning compared to the CAPM expected return. In the case of MFX it is 15% minus CAPM, which we have already calculated here. For X it is 12.17 and 12.17 and 11.81 in case of Y, which is given here, and for portfolio also. So this would be the alpha. Thank you.